roughly. All I'm trying to say here is it looks to me like cash balance grew year over year, which is a great thing to see in a business. We'll see how they actually generated that money. But for right now, the very first observation, cash is large and cash has grown year over year. Company inventory is extremely low relative to cash, and inventory has not moved high relative to so much revenue that they've gone. They're really not carrying a tremendous amount of inventory. That's going to mean they don't have to put out cash to source the inventory and then hold it waiting to sell it to customers. So I think that's a very interesting element to their business model. Prepaid expenses, so current assets $265 million, restricted cash, fine. Goodwill, $100 million. That's a lot of goodwill, and that relates to the acquisitions that they did when they put this Hims and Hers together with another, I think it's ORCOAC. It looked like it was a reverse merge into that business. So this goodwill here is very large and is basically them overpaying for the reverse merge. Property, plant, and equipment, $36 million. Not much. Intangible assets, 18. So really, the balance sheet of $141 million is predominantly, more than half of it, about half, is current assets, which I like. I'd like to see more physical assets, but they don't manufacture anything. They're an online internet company. I don't expect them to have a lot of buildings and office space and retail space, so the assets can be fairly light here. Liabilities, what do they actually have to do? $88 million in liabilities. That's basically accounts payable, fine, decent move year over year, not a big deal. Accrued liabilities, again, not too much of an issue. Some deferred revenue, definitely growing in the deferred revenue, but might be manageable. And there's an earnout, some sort of like tail for an acquisition that they made, they might have to pay out. But overall, the current liabilities are a lot less, liabilities are a lot less than current assets. Love to check the box. That's Ben Graham special right there. In fact, cash on hand and short-term investments of almost $200 million can wipe out all liabilities at $100 million. So they have a lot of staying power here. These guys have a lot of assets that if they can figure out how to monetize their customer base, which they might be getting to do, they have a lot of dry powder here to go and expand and continue to market and continue to grow the business.